Hey everyone, hope all is well, and welcome to the first episode of Retire Your Way. And on today's live, we're going to discuss Peter Thiel's Roth IRA, how he was able to turn a few $1,000 into a few billion. And we'll talk about basically how he did it, the legality of it, and kind of go through some thoughts. This is going to be a very fun, casual live session. So if you have questions, just send them my way. You can chat them, and I will do my best to respond to them. But kind of want it to be interactive, want it to be fun, and kind of do this together. So I'm just going to start it off. We'll try to go for 45 minutes or so, kind of see where it goes. But what I want to do is kind of just start off and give you just a background of how we got to this point, right? So ProPublica is a news organization that released an article a week or so ago talking about Peter Thiel, who's a very successful investor, hedge fund investor, how he turned just a few $1,000s into what they say is $5 billion tax-free in a Roth IRA. So obviously that creates a lot of interest, a lot of chatter, right? How the hell do you turn a couple $1,000 into $5 billion tax-free? And definitely it becomes political, right? Is this too much money? Is it fair? Is it abuse? How can you do this? I don't understand. It can't be legal. So we're going to go through everything. Let me start with what a Roth IRA is, right? In 1997, Senator Roth, Delaware Senator, created what is known as a Roth IRA, which was approved by Congress and codified in the tax code under Section 408A. So it's something that has been established by Congress, right? So the form of the Roth IRA is codified in law. So the concept, if you look at the legislative history of the Roth IRA, the intent was to encourage more people to save for retirement. And you can argue that, hey, the intent maybe wasn't to allow rich people to have billions of dollars tax-free. But guess what? The IRS, Congress, Treasury, everyone was aware that people can accumulate tax-free wealth with their retirement account. So it's not something the IRS didn't expect. So why didn't they cap it at that time? They could have. They could have said no one can accumulate more than X amount of dollars in a Roth IRA. They didn't do it. Okay. And they had every opportunity to. So Roth IRAs are after-tax account. You do not get a contribution deduction for making the Roth IRA contribution. But so long as you're over 59 and a half and the Roth's been open at least 5 years, all your gains are tax-free. Now, starting in 2009, you were able to convert funds from a pre-tax IRA to Roth without any type of income limitation. And this was done to encourage people to pay tax on their conversions because the Treasury needed the money after the financial crisis. Now, obviously, the traditional IRA, we all know what that is. That's a IRA where you can make a contribution and get a tax deduction. Once you're over 59 and a half, you pay tax on what you pull out. And if you pull the money out prematurely, you pay tax and a 10% penalty. So the Roth IRA was just another angle on the traditional IRA. It's a way to encourage more people to save. And the carrot they were dangling to all of us was, hey, get tax-free growth. It was also pretty attractive to the Treasury because there was no tax deduction for the Roth IRA, meaning no less tax revenue that will be rolled into Treasury. So it also was something they were interested in. So this is something obviously that was there. It's codified under 408A. The form is there. Now, something that Peter Thiel in 1999, according to the article, went to a self-directed IRA company. It was actually Pensco in San Francisco, and said, hey, I have this small hedge fund and I just graduated Stanford Law, smart guy, and I want to figure out a way to use my IRA to make investments. And then the owner at that time, Tom Anderson, who I know well, is a fabulous guy, ethical, and really a founder of this industry, said, hey, you should think about the Roth IRA. It does the same thing as a traditional IRA, But guess what? All your future gains on these future startups that your fund will invest in could be tax-free so long as you're over 59 and a half and you keep the Roth open 5 years. So Peter Thiel said, wow, this is pretty cool. I'm going to do it. And that's kind of what happened. He started off with PayPal. And that was the first company he started with. And according to this article, and let me just preface what I'm about to say. This is all based off this ProPublica article, which you can check out online. And interesting enough, all the information they received was from an informant in the IRS, because it is illegal to transfer people's confidential tax information. Okay, you can't just capture someone's tax information without their consent. So they had an informer in the IRS, or one or many, no one knows who these people are or person, who accumulated information on a number of highly successful and very wealthy individuals, most of them billionaires, and provided ProPublica with the information. And ProPublica is now, look, they've done something on Bezos, they did this on Peter Thiel, and I'm sure they're going to do a bunch more exposés on rich people. And interesting enough, not only did they get the 1040, which is the income tax return these individuals filed, but seemingly they were able to capture the retirement account or IRA info, which is generally found on a form 5498. And interesting enough, the 5498 is not attached to the 1040. So again, I don't know. I've never worked for the IRS. I don't know how they gather information of taxpayers, but clearly this person or group of persons who sent the information to ProPublica was able to figure out a way to also not just send the 1040s, supposedly they did this for the last 15 years, but also the 5498, which basically shows the value of the IRA. It doesn't show what the IRA invests in on a deal by deal, transaction by transaction sequence. It just basically shows you the value. So somehow they got this information and they went with this article. Okay. And basically all we have to go off is what they've written. So what they're saying is that basically Thiel started with $2,000 and he was able to do a Roth IRA because at that time he made less than the income limitation, right? He was just starting off. One other thing I should mention is not everyone technically can make a Roth IRA contribution. If you make more than $208,000 and you're married, file jointly, you cannot do a Roth IRA contribution. However, since 2010, you're able to do what's called a backdoor Roth IRA, which basically means you do an after-tax IRA contribution and then convert it to Roth. And you can do that if you make $100 million. There's no income limitation because the conversion limitations were erased in 2009. So at that time, though, Peter Thiel seemingly had less money than the income threshold. He wouldn't have been able to do the conversion otherwise. And he did a Roth contribution of a few $1,000s. Okay. And then seemingly what happened is he invested these funds into a startup called PayPal. And it's important to state that no one knew what PayPal would be at that point, right? It's impossible to know if PayPal would be a hugely successful company or just another failed startup in Silicon Valley at that time. Right? I can tell you, I have many friends that worked at startups in the late 90s in San Francisco, and most of those failed, right? They got huge valuations, they raised tons of money, they got all kinds of stock, and most of these failed. Peter Thiel got lucky on PayPal. Clearly, it's one of the most successful companies, been public for a long time, and he clearly did very well. So he was able, according to this article, buy shares at 0.001 per share. So his $2,000 or $1,700 of shares, turned into quite a bit of money in future sales of that stock at much higher valuations. So the question is, how can he fund this? So let's look at the IRS rules. Internal Revenue Code section 4975 governs what you can and cannot do with an IRA. And it basically says you cannot do any self-dealing conflict of interest transactions, meaning you can't invest in an entity you control or own more than 50% of, or any transaction where you're making the investment not specifically or exclusively to benefit your retirement account. So in this case, it is understood that Thiel owned less than 50% of PayPal at the point he bought the stock. So even though it was founder stock, there were a number of other founders, I think even Elon Musk, and he was able to buy shares for $1,700, 1.7 million shares, and he owned less than 50%, including his personal stake. So from a prohibited transaction standpoint, seemingly he was okay. Now, the other way you can attack a transaction in an IRA is value. Are you paying fair market value for this asset? And the question is, if you're not, then you're overstuffing your IRA, right? If you have a business or an asset worth $100,000 and you're dumping it into an IRA and paying $6,000, you have an issue here of, number one, fraud, right? There's listed transactions where you're not allowed to stuff undervalued assets into a Roth IRA. And then you potentially have a situation of overstuff in your IRA, excise tax as well. So in this case, they couldn't prove that either because he did pay what other founders paid. And how do I know they couldn't prove that? Well, according to a Government Accountability Office report of 2014, which is available online, they seem to have audited Thiel. And the ProPublica article references the fact that they actually audited Thiel around the 2012 to 14 range of years. And guess what? They weren't able to uncover anything abusive because they didn't pursue any audit of Thiel. So what does that tell me? That tells me is they looked at these two factors. How do I know that? You can read the Government Accountability Office. It's right in there. If you just Google founder stock, there's like 5 or so pages that I encourage you to read. And you'll get some really good data on exactly what I'm talking about. But they basically tried to attack the transaction on prohibited transaction. Did you own more than 50% or more? Even if you own less than 50%, they still could have potentially argued prohibited transaction if they could have showed the investment was done to benefit Thiel individually. But when you invest $1,700 in a company, it's hard to argue that the company really needed that money, right? Even though Thiel could have been a founder, it would have been very hard for the IRS to argue that that $1,700 really made a difference, for PayPal and helped him out personally as a founder of PayPal. If he invested $100,000 or $1 million, yeah, the facts are different, and maybe the IRS would have come out with a different conclusion. But based off the facts, the value was so low, the value was accurate, it was in line with other investors and what they paid at the time, they walked away. So it's actually very interesting. So ProPublica mentions that, and they reference that in their article. Now, I'll also mention that clearly ProPublica has an angle here, right? They are looking to go after super wealthy people. It's just, there's a reason the informant, whoever gathered all this information inside the IRS, there's a reason they dumped it and sent it to this organization. They expected that the news organization would write articles that were tilted to what they were trying to get across, that, hey, there's too many rich people out here not paying enough taxes. And again, I'm not going to sit here as a tax lawyer saying that's right or wrong. That's for the IRS to decide. But I will state what I always do based off Gregory v. Halvarian, a famous Supreme Court case that says clearly no one is forced to pay the maximum amount of tax. We all have a legal right to minimize our taxes within the legal realm of the code. And we'll talk about this in a little bit, but that's exactly what Peter Thiel did. And it's not just me saying that. The IRS said that as well when they could not find anything to go after Peter Thiel. So what he did is, according to this article, is the investments obviously turned out very well. PayPal did super well. He then was able to get into Facebook. Hey, listen, God bless him, right? And he was able to buy into Facebook at an early stage. Okay. And then he got into other companies. So from the PayPal stock, he was able to take $1,600 and go to 3.8 million. So a 227,000% increase. And then in 2002, eBay purchased PayPal and he got about 28 million bucks. So he turned $2,000 into $28.5 million. How do we know all this? Again, supposedly when he tried to get residency in New Zealand, according to this article, and in order to get residency in New Zealand, you have to provide certain financial statements on your net worth. And that's where this information was provided to. And that's how ProPublica was able to capture this information. And then he had the opportunity to found Palantir, which just went public recently in 2003. Was a CIA-backed venture fund. And again, did really well. In 2004, he met Zuckerberg and he invested $500,000 in Facebook stock. By the end of 2008, the Roth was worth $870 million. Okay, again, That's what, according to, I assume, is IRS Form 5498, because it would not be on the 1040. It would not be on any other tax return. The only way you would get the value is on a 5498 form, which the IRA custodian needs to file, or if they were able to capture this from some New Zealand financial statements that were provided. The article also did say that he actually did pay some tax. So in 2010, he took out 254 million. I guess he needed to live on it, and he paid tax on it, right? Because when you pull money out before 59.5, you have to pay tax and a 10% penalty. So he did bite that bullet. So the IRS did get tax revenue from some of his Roth IRA wealth, and that's an important point to make as well. It says in 2011, the IRS started looking at him, and again, from 11 to 13 or so, they were able to continue to seemingly pursue Thiel, but were unsuccessful in audit. Nothing ever went to court, and we have no knowledge of any tax payments, penalties paid by Thiel. And we know the Roth IRA wasn't attacked because it's still intact. Now, we all remember Romney running for president in 2012. I got interviewed by the Wall Street Journal on this, and that brought Roth IRAs again to the forefront, where people estimate Romney as anywhere from 20 to 100 million in a SEP IRA, not a Roth IRA, because Roth IRAs, he wasn't able to get into one at that point. And again, what he did, similar to Thiel, he had his IRAs along with his partners invest in some Bain Capital, which is a private equity firm, like a Domino's deal, some other deals they did, and they did really well. And they were able to shift, I don't want to say shift, but they were able to allocate some of those gains to the IRA based off the way the distribution waterfalls were drafted in the partnership agreement. So IRAs got into the public eye when Romney was running for president, and then kind of dropped out of sight for a bit till really about 2016, when Senator Widener of Oregon kind of proposed caps, Roth IRA caps of $5 million. That didn't go anywhere, kind of stalled. And then when President Trump took over, essentially just there's no momentum for any bipartisan support on caps. And we'll talk about that in a minute, whether that can come back. It's very possible. So anyways, if you go through the article again, just going through some more information here, it basically concludes that if you look at Thiel's investments into Facebook, Palantir, PayPal, and some other stuff, he amassed billions of dollars. Do I know it's true? No one does except the IRS, right? And let me say it again for the record. The IRS has every opportunity to audit Peter Thiel. They can do it anytime they want, right? They may pick different taxable years because there are statute of limitation, but they can continuously audit him if they wish. They seemingly have not. Okay, so that's something to also state. So now that we have the facts, and I'll get to some of these questions, this session, it's being recorded, so don't worry if you missed this. Let's talk about how he did it, right? So he was able, because he owned less than 50% of a startup, he was able to use his Roth IRA to invest in startup shares. Now, it may not work for all of you, right? If you're starting a pizza restaurant or the next great Facebook with 2 or 3 of your friends, and you're each going to own, close to 50%, or if it's 2 of you, or even if you're under, and it's a closely held group of shareholders, you run into some potential issues of self-dealing, right? I always use this Rollins v. Commissioner case. It's a really good case to go through what the IRS is considering when it comes to prohibited transactions. So what they're looking, if you look at the Rollins case, is in Rollins, he was an accountant. He invested in a bunch of businesses, not actively involved. He owned, in all cases, less than 50%. These businesses needed money, which is a key fact. He took his 401k, invested in the business, and the IRS argued that it was self-dealing, that he made the 401k investment exclusively to benefit his personal business interests, not the 401k, and tax court agreed. And they basically said, listen, when you make an investment, it needs to be made to exclusively benefit the retirement account and not you personally. So what I'm trying to say is you got to have the right facts. If you are starting and you need the money and your IRA is going to invest $50,000 and it's you and 2 other people, could be prohibited. If you look at Rollins, like, are you doing this investment to help your IRA, or are you doing it to help yourself and your business get off the ground? Thiel's facts were good because he only put in $2,000. Interesting enough, the IRS argued, substance over form, right? That's what they tried to argue, that, hey, this is no substance. You can't turn $2,000 into 5 billion or into 25 million. It's not possible. The whole concept of a Roth IRA is not to accumulate that type of wealth. Well, again, the IRS wasn't able to argue that, and form prevailed. The fact is, Roth IRAs are trenched by Congress into the tax code. There's no cap. They were obviously aware that people can accumulate unlimited wealth in a Roth IRA, and they didn't stop it. So at the end of the day, it would be very hard to attack this. The best ways the IRS could attack a similar transaction, if you're an entrepreneur or part of an investment fund and think you're investing in the next Facebook or the next Google, you want to keep your interest low. Actually, probably the less money you put in, the better, because it's hard to argue that the $2,000 or the $7,000 actually will make a difference in getting the next Facebook off the ground versus putting in 100 grand or 300 grand, which is more significant. And then make sure you're paying what everyone else is paying. So if you're offering friends and family a chance to buy in at a penny a share, then your IRA could buy in at a penny a share. If you're asking $100,000 a unit, you can't give your Roth IRA the ability to buy in for 1 penny. Okay, so make sure that you are consistent. It could work. This could be a very powerful tool for a lot of startup investors, a lot of startup funds. And this is an unfortunate part. I actually had lunch with someone. We were discussing this today. Not everyone gets the opportunity to do this stuff, right? It's just unfair world. We don't all live in Silicon Valley. Peter Thiel was lucky. He was connected. He was embedded in this community of startups in Silicon Valley. If you live I'm in New York now. If you live in New York, you may not have that opportunity. You live in Ohio or Texas, you may not have the opportunity, and just unfortunately just not something you're going to be able to do. But he was able to do it because he was in the Silicon Valley. He was smart enough, got good advice to use a Roth IRA. And I know this isn't a popular take, but he did nothing illegal, nothing. He followed what the code says, is you can use your Roth IRA to make investments so long as you don't violate 4975. They're not life insurance or collectibles. And he did that. The IRS looked at this, and I'm assuming they've looked at it more than just once, and they have not been able to make any claim against Thiel's IRA. So it's something that we can learn from. Yeah, it maybe doesn't seem fair. How do you turn 2,000 into 5 billion, or how many billions he has? I don't know. But my attitude is what makes America great. It's not a zero-sum game. There's nothing wrong with all of us being wealthy. We all can do this in some capacity. It may not be real estate. It may not be founder stock. It may not be Bitcoin, but the Roth IRA gives us all the power to gain tax-free wealth. Why should we punish Peter Thiel for being successful and smarter than all of us? I mean, he could have invested in the next eToys or some one of these startups that just never went anywhere. He got lucky. He's smart. I mean, God bless the guy. I mean, honestly, I don't have any. I don't feel bad saying this. I don't. And does the IRS, are they losing tax revenue? Maybe. But when he dies, this will be part of his estate. IRAs are part of his estate. He will pay estate taxes on this money. He's already taken out hundreds of millions of dollars and paid tax and a 10% penalty. So he actually paid more tax on that money than he would have if he just got capital gains and owned it personally. So again, I don't know the numbers. All I'm doing is going off what I read off ProPublica, but it's definitely slanted and it's tilted to scaring people and telling people this guy's a criminal. He did something wrong. He's got an evil bend and we need to stop this from happening. And I'm saying, no, he didn't do anything illegal. I don't know who Peter Thiel is, and I don't really care who he is, but he didn't do anything wrong. He followed the form of the Roth IRA, and he used it brilliantly. And instead of, if you want to be mad at anyone, be mad at Congress, okay? Be mad at President Clinton. I mean, he was in power when the Roth IRA was created, okay? Don't be mad at me. Don't be mad at Peter Thiel. Be mad at President Clinton. Be mad at Congress. Be mad at the Senate. They could have amended it and capped Roth IRAs. Senator Widener of Oregon is trying to do it again. He recently, a week or so ago, said that he may introduce a bill to cap Roth IRAs. I don't think it's necessary. Do we cap people's wealth? Do we cap the amount of life insurance people can have? Why are we capping how much people have in their IRAs? Like, why are we doing that? There again, it's not the whole point of this. There is, first of all, not that many people that have IRAs over $5 million. There's like hundreds, maybe thousands, not many, right? So you're not really making a big impact other than just making a public statement against wealth. You're not really capturing much additional tax revenue. It's kind of a waste. But listen, there could be a momentum to do something like this. We'll see from a political standpoint what occurs. But I'm telling you that what he did is legal. How he was helped to do this was legal. Nothing was done wrong. We all can do this if we have the right facts and circumstances and opportunity. And if you're going to be mad at anyone, be mad at President Clinton, Senator Roth, and Congress. Don't be mad at Peter Thiel. We can have the same opportunity. So if you are a entrepreneur, venture capitalist, something you can consider. You can try to follow the Peter Thiel blueprint. I've had a lot of people call me in the last week. I've been interviewed by a bunch of news sources on this. I'm not sure if they get published. We'll see. But there's obviously a lot of chatter about it. People don't understand it. They read the ProPublica article and they're like, this guy is a horrible human being. I can't believe he did this. But they don't understand the rules. And that's my job as a tax lawyer, to tell you what the rules of the Roth IRA is, what the legislative history is, and the fact that Treasury, Congress was aware of the unlimited potential to generate wealth, and they did nothing to cap it. Okay, and they could have. And it's just the facts. And we've seen this in other tax cases. There was a recent tax court case dealing with foreign sales corporations, Mazzei case. In the Ninth Circuit, the IRS tried to attack it because this family was able to invest a little bit of money, $3,000, and turn that into a lot of money tax-free. And they argued, hey, the substance doesn't meet the form. You shouldn't be able to do this. And the IRS said, actually, the tax court initially agreed with the IRS, but the appeal court correctly ruled against the IRS and said, no, the form is what you need to look at. The IRS codified the DISC, which was the prior entity, a foreign sales corp type entity, and they allowed IRAs to be shareholders. So when they created the foreign sales corp, they could have stopped IRAs from being shareholders. They did not. The fact they did not shows that they had no issue having IRAs as shareholders of foreign sales corps. The same way they could have capped Roth IRAs. They could have said you can't do this or you can't do that, but they did not. Okay, so that's one of the reasons the IRS is not going to be able to attack this, is they don't have the ammunition to do so. So if you're out there and you have the right circumstances, you think you can invest in the next Facebook or Tesla, consider the Roth. Why not? I mean, I do it with cryptos. I haven't had a great opportunity to do it with startups. I wasn't able to do it with my business because of the ownership requirements, but I would do it in the future if I had the opportunity. So again, just something that you should think about. This is the whole idea of like retire your way. I want to empower people to understand how the rules work, what tax code says, what you can and cannot do, so then you can make your own choices. Just like Peter Thiel made choices for himself, you should be empowered to make choices for yourself, which again, I think is an important part. So let me look at some of these questions. Again, this is something I just wanted to jump in. I'm going to do more of these YouTube lives. I kind of like them. They're interactive. They're fun. I can jump on things and just kind of talk about topics very casually. This is something that I've really been focused on. I wrote a book on the Roth IRA. It's really the best legal tax shelter out there. Even if they cap it at $5 million, I'll live with it. Even though I think it's wrong and there's no reason to cap a Roth IRA. Why do you cap someone's wealth? You say, well, you made too much this year. You can't make any more money. Guess what? I was born in Canada. That's what they tell doctors. Well, you made too much money. You can't make any more money. So you know what they do? They go on vacation. It's backwards. It's not the way the system should work. So, but if they cap it at $5 million, who cares? There's still tons of opportunity to generate tax-free wealth of up to $5 million. I don't think they're going to be able to cap it. The Ways and Means Committee, which generally is focused on tax legislation, is generally bipartisan. I don't think you'll see many Republicans go forward on this, even though the Democrats control the House. They like to do stuff bipartisan when it comes to retirement accounts. So I don't really see it happening, but we shall see. It's something that we got to keep our eyes on. But again, the Roth IRA is a powerful tool, not just for founder stock, but also real estate or Bitcoin or gold or hard money loans. It's a tool that we all need to focus more on, whether tax rates go up, capital gains tax rates go up. We don't know, but the ability to lock in tax-free growth for your future is super exciting to me. So let me get into some of these questions. Thank you, David. This is the best information on retirement plans. Thank you. I appreciate that, David. I do my best. I really am passionate about this. I really believe that it's a zero sum. It's not a zero sum game. We all can be rich. I wrote a book, 7 Figures at 70, recently, just about a year ago. And I believe it. We all can be 7-figure millionaires if we just do 3 things. Start early. Even if you're a little old, it's never too late. Make contributions. Be consistent. Even if it's tough, COVID, put in a little bit of money. Even if you can't put in 5 or 6 grand, put in $500. Put in $300. Put something in. And this is the most important part. Trust the process. Be patient. Patience is a virtue. It helps. It works. If you let your money work for you, compounding interest, 8th wonder of the world, compounding returns, you will be rich. Okay. Whether you invest in the next PayPal or you just buy ETFs or you buy gold or Bitcoin, I don't care. Over the next 30, 40 years, you're going to generate between 8 and 12% rate of return. Just the way the markets work. Again, even if you're just invested in the S&P 500, that's fine. You'll get around 10% over the next 30 or 40 years. So you'll be rich. Just, listen, just do it. If you take anything away from this podcast or this YouTube live, I should say, go open a Roth IRA if you haven't done so already. Now, if you make $1 million, you can do a backdoor Roth. Just do an after-tax IRA and just move it to Roth and just keep doing it every year. You'll be happy in the next 10, 15, 20 years when you see that money grow. And it's all tax-free. It's going to make you sleep so much better at night. I know it does me. I'm 46. I got 13. So a lot of people say, oh, I don't want to get older. I'm like, I actually want to get to 60. God willing, I'll be healthy because I want to touch my tax-free wealth. I've worked so hard to generate, what I think is a really nice nest egg, not as big as Peter Thiel's, but I'm working on it. And it'd be nice to pull some of that tax-free. And that's what I'm really looking forward to. So can you buy ISOs in a Roth IRA, incentive stock options? Okay, this is the issue with options. The problem is when you get a stock option, let's say you work at Tesla. Okay, you're an early employee of Tesla or Google. They give you employee stock options incentive. Generally, that's based off you working at that company, right? So it's tied into your performance of services. So it could be risky shifting that ISO to your Roth. So you're going to have to structure it properly to structure in a way where it's not directly tied into your service. Sometimes it's not possible. So in a perfect world that you can get your Roth IRA to buy stock options not tied into your service, it's not always possible. I've talked to a lot of clients looking to do ISOs in a Roth IRA, and sometimes it gets messy because the IRS can look at that as shifting of income, right? It's like saying to your employer, you know what, don't pay me, just put it in my Roth IRA. Is it taxable revenue, right? You saw that what's going on with the Trump organization, right? They nailed his controller for fringe benefits, right? You got an apartment or pay for your kid's school, you need to report that as taxable income. You can't just not report it. Same way, if you have an incentive stock option that's tied to your performance of services, you shift it to a Roth IRA. Could the IRS try to argue that there was something not legal in that transfer? It's possible. It's much easier when the Roth buys into a company on its own that's not tied into your performance of services. So in like the Peter Thiel case, it seems to suggest based off this facts provided that he was able to buy in at the same price as all the founders. So it wasn't tied into his service in the company, but hey, as a founder, all founders were able to buy a certain amount of shares at a certain price. I don't know all the facts. But I do know that if the IRS felt that there was something egregious here, they would have attacked it. I can guarantee it. So the fact that they didn't, either they missed the statute of limitations, which could be a biggest issue. The PayPal stuff happened in the maybe late 90s, early 2000s. They audited Thiel in 2011, 12. It's generally a 3-year statute. So they could have missed it, but they may have been able to get him on other stuff, but they didn't. So that's all we can go off. But the ISO is a good question. Thank you. Next question. If there's an investment that allows you to do an equity match on an equity in your home, can you borrow 50 from the solo K for the match or to be considered a prohibited transaction? So okay, this is a little off topic, but yeah, if you do a 401k loan, you can use the money for anything. So if you borrow 50K from your 401k, assuming you have 100, you can use it to do it. You can go to Greece on vacation. You buy yourself a watch, go buy yourself a car. I don't care. So you can do whatever you want with it. I would like to see if a client of Adam, we have a Facebook group or something, discuss opportunities we come across. Yeah, it's fine. Just, you can reach out to me. You can email info@IRA Financial. Just say for Adam and it'll get to me. I'm currently a client of IRA Financial as a doctor. Do a backdoor Roth. Up to what age can I do that? You can do it as long as you have earnings. There's no age limitations on Roth IRAs. There used to be on pre-tax IRAs, but they got rid of it under the Secure Act. So doctor, as long as you have income, you can do backdoor Roth. Can we email your firm a specific scenario? Yeah, email info@IRA Financial and just say, attention Adam, and someone will send it to me. I'm happy to look at scenarios if people have questions. It's very facts and circumstances based. And I'll also say this. If you pay me $10 million or you hire the best lawyer in the country, it's often very gray and very facts and circumstances. So I'm not able to give you a explicitly concrete answer. Unless you say, hey, Adam, can I buy Tesla stock or can I buy Apple stock? Companies that are publicly traded, zero risk. Or can I buy a house and rent it to a third party? It's zero risk. But anytime it's closely held, private business, let's say under 50 shareholders, and you're putting IRA money and you have some personal involvement, whether you're an executive or you work there or you have a personal investment into the company, there's always a sliver of risk. I can't tell you how significant that risk is, but there's always risk. So you just got to kind of be able to digest that risk and understand what the potential is. So how does the IRS, what happens if they attack this? And this is actually very interesting. A lot of people don't know this. When the IRS attacks a transaction for a prohibited transaction, what they do is they attack it on the day the transaction occurred. And they attack it based off the amount of IRA assets that were invested. So for example, you put in $2,000 into an investment in 2019, okay? And it turns out you did a prohibited transaction. You invested in your own business. Now it's worth $100,000. All the IRS can get is tax on the $2,000 because the prohibited transaction occurred at that point when you made the $2,000 investment. It's deemed to blow up the IRA on the date that transaction occurred. So you're going to pay tax, potentially a 10%, maybe 15%, maybe a little bit more excise tax. I've seen up to 15%. I haven't seen the IRS go above the 15%, but it's technically possible. I've seen they argue they can go up to 100%, but they would be off the initial investment amount. So let's look at Peter Thiel here. He puts in $1,700. Let's say they nail him 3 years later and it's worth $25 million. Think about this. All they're getting is $1,700 tax, the tax on the $1,700 plus maybe a 15% penalty. What happens to the stock that he owns in PayPal? That becomes his. So it goes and it converts from an IRA asset to an asset he owns personally, and it's a capital asset now. So he would get capital gains tax, and he'd pay 15 or 20% capital gains, and that would be it. So it's interesting. If you're going to take risks, take it on very small amounts of money. If you take that risk on $100,000 or $500,000 or $1 million, your risk is much higher, and your monetary loss could be much wider because your amount invested is higher. And I'll give you a quick example. About 10 years ago, I had a doctor in New York that used his IRA to do real estate. And he started in 2010 when the market was really low, right after the financial crisis. And I think this was like 13. It was before the 3-year statute, like a month before. And he calls me up and says, Adam, I'm over 72. I got this letter. They want to know about my IRA. So I sent them all this information. And it turns out I screwed up. And I wrote a $500 check from my checkbook IRA LLC. Instead of it going to the contractor, it was a similar company name. And it seems like it went to me. And they went through my bank statements and they asked me about this check, and I'm in trouble. I said, oh man, that's crazy. Let's talk to the IRS. It's $500. You have like $500,000 in your IRA. You're a doctor. You can just tell them you didn't know, you made an innocent mistake. And well, I'm sure it'll be fine. And we have a discussion with the IRS. We meet with them. And the IRS is like, nope, sorry, strict liability. You're done. We're blowing up your IRA. Oh man. So we have a meeting with like a side meeting with the client and the accountant. And the accountant's like, wait, Adam, what are the rules? I was like, well, when you do a privilege transaction, they're going to attack it on the day you do the investment, right? On the day that check was written, which was in the beginning. And then it turns into a capital asset. He's like, okay, let's accept the tax. We're going to penalize him. They're just going to tax him because he was over 59 and a half. I was like, what do you mean? You don't want to fight this? He screwed up for $500. He goes, no, listen to this. We made these investments. The assets were $250,000. They're now worth almost $600,000. Okay. I'm happy to pay ordinary income on the $250,000. I'll lock in capital gains on the rest. And this way, when I sell them, I'll get capital gains. It's like, wow. And we ran the numbers and he was going to end up saving like hundreds of thousands of dollars doing it this way. So it actually worked out in his favor. The IRS basically were stuck in this box where they had to attack the transaction on the day the privilege transaction occurred, the day he wrote that check, which was in the beginning of the transaction period. The value of the real estate was super low. They only got tax on the low valuation, and the doctor was able to get these assets capital gains. And I'm assuming he sold them in a capital gains instead of ordinary income when he would have taken required minimum distributions and paid ordinary income tax instead of a capital asset. So what I'm trying to say in a long-winded way was the IRS isn't always smart. Number two, if you take small bets, your risk is very low. Because even if that $2,000 turns into $5 billion, all they can go after is the $2,000. Because assuming the privilege transaction occurs at that point. So the risk profile is low. I don't want anyone getting audited. I don't want the IRS after anyone. But again, the amount of monetary loss is super low if you invest super low amount of money. So again, it's not a popular take, but I think what Peter Thiel did was brilliant. I personally, would do it myself if I could. That's why I love the self-directed industry. Is it something unpopular to say? Maybe. I would tell someone who's super progressive who thinks it's bad for to have super amounts of wealthy people. Well, you'll get the money. He'll pay estate tax. He's going to pay high estate tax. Half of that money is going back to the government. And guess what? IRAs, there's $12 trillion in IRAs. There's $32 trillion in retirement accounts. It's a very, very important source for startups. I have so many clients investing in startups, all types. So IRAs are a very, very important part of stimulating our economy, creating jobs. You know how many jobs are created at PayPal, at Facebook, at Palantir? And yeah, his $2,000 initial investment in PayPal obviously didn't hire people, but as his IRA grew, he invested more than $2,000, whether it was Facebook or Palantir or other investments. So he's added value to the economy. He's created jobs. He's going to pay tax on that at a high rate. He's already paid tax when he took an early distribution. So it's not all bad. And again, we all can do this too. It's not just a rule for Peter Thiel or for other smart Stanford law students. I'm telling you how to do it. Okay. We all can do it. If you have the right situation, we can emulate what Peter Thiel did. We just need to be smart and lucky. And guess what? It's not so easy. So when Congress is debating, putting caps, it's not so easy. And trust me, these people are smart, they're brilliant, and they're lucky. And why should we penalize them for that? Doesn't seem fair. It's probably, listen, you may come after me for that, and that's fine. And I'm happy to have a healthy debate about the principles of having too much money and whether that's good or not. But looking at Section 408, looking at the codification of the Roth IRA, Peter Thiel did zero wrong, and the IRS seems to agree as well. So you may think it's gross or ugly, but I kind of jealous. I'm kind of jealous. So let me go through a couple more questions, and then we'll kind of end for today. But I'm hoping to do this every week. I drop 3 podcasts, 5 videos. I don't care. I love talking to all you guys and ladies and providing as much content as I can, helping all of you, especially if there's up-to-date, newsworthy items. I definitely want to share my thoughts and love to hear your thoughts as well. How much can I catch up? So the Roth IRA is $6,000 or $7,000. That's the most you can do. If you're self-employed, there's something called a mega backdoor 401k, which I actually just wrote a Forbes article on, and actually compared the backdoor Roth IRA with the backdoor Roth 401k. You can check it out. I just dropped it on Forbes about a week or so ago. And if you're self-employed, you can go up to $58,000 or $64,500. So it's a pretty good opportunity. Can you speak more about how you purchase real estate with an IRA? The value of the property is typically much higher than the contribution limit. So how do people accumulate money to buy real estate? Well, they usually do it through rollover, Andrew. So you work at company ABC, you put money in a 401k for 5, 10, 15 years. The contribution limits on a 401k are much higher. They're $19,500 or $26,000 if you're over 50. So you can accumulate money much quicker. So even if you put in $7,000 for 10 years, that's $70,000 could be worth 130, 140. You leave your job, roll that into self-directed IRA, buy real estate. You're right. IRA annual contributions are $6,000 or $7,000. You're not going to buy much. But you can do a SEP IRA, which can go up to $58,000. You can do the 401k, the $19,500 or the $26,000 plus any match, or you can do the solo K, which can go $58,000 or $64,500. So there's opportunities. You can also get a non-recourse loan to buy real estate, which will allow you to commingle your retirement funds with a loan to buy real estate, which is another way you can do that. Why invest in any money, anything but crypto? Okay, good point. But diversification does work. I'm a big crypto lover. I'm also a big real estate lover. I think I sleep well at night knowing I have my money in 3 places: cryptos, real estate, and equities. And again, I'm a bigger crypto fan than you're not going to find bigger crypto fan than me. If I could, I'll do everything in Bitcoin. I'll sell my house in Bitcoin. I'll transact in Bitcoin. I give gifts in Bitcoin. I love cryptos, but diversification works. And I think that's an important part of the self-directed retirement industry is we let you diversify. You don't just have to buy stocks or ETFs. You can buy cryptos or real estate, founder stock, hard money loans. So there's a lot of really cool stuff to do. And I think we all can learn from Peter Thiel. Read the GAO report. I've done a bunch of blogs on it. It's on our website. Just search for founder stock. It's a long document. It's like 70 pages. But there's a couple of really good nuggets of information there on 3 or 4 pages. And it goes through some details about founder stock or even potentially putting a carried interest into a Roth IRA, which Thiel didn't do because he invested in startups. Now, the last thing I want to mention is this. If you are investing in a startup and the startup's a pass-through entity like an LLC, you may trigger what's called UBIT, unrelated business taxable income. So in the case of Thiel, the companies he invested in were corps, right? Think of a corp, a big box. C Corp pays corporate tax, now 21%. And then dividends of retained earnings go to the shareholders, and the shareholders pay tax. It's called 2 layers of tax. And that's why there's no UBIT, unrelated business taxable income, on a C Corp. And that's why you probably never deal with it if you invest in mutual funds or ETFs or stocks, because almost all public companies are C Corps. Now, if you invest in an LLC or partnership as a startup, which does occur, a lot of the larger startups that are looking to raise money generally are Delaware corps. But I've seen investment opportunities in LLCs for startups. Just beware that if there's cash flow of extra $1,000 that's allocated to your IRA, you may owe UBIT tax which can go as high as 37%. So just ask, hey, is this an LLC? Is this a partnership? It's a corp. If it's a corp, no UBIT. You don't have to worry. If it's a partnership or LLC, you need to think about, hey, I may have to deal with the UBIT. In some cases, the LLC manager will give you a tax distribution. They'll give you money to pay the tax on the allocation of profits, which is called phantom income if there's no distribution of cash. So you need to ask these questions because even though your goal is to have capital gain sale with no UBIT, when you sell your LLC interest, there's no UBIT on a capital gain. But on an annual basis, if there's cash flow, you may be subject to the UBIT tax. Yeah, some startups don't have a lot of net cash flow, but just good question to ask. So if you do some crowdfunding sites, think about whether you're investing into a pass-through entity like an LLC or a corp, which would block the application of the UBIT tax. How do you sleep well about cryptos? Can't get lost on the internet. No, well, I sleep well because you can put it into a cold wallet and put it in a safe, and you don't have to worry about getting hacked. So there's safe ways to hold cryptos if you want. So the last thing, it's super hard to onboard with Gemini. Well, if you use our platform, we can do it for you in days. So you don't need to go directly to Gemini. You can open an IRA with us. We'll link your account to Gemini through a partnership we have, and we'll onboard for you in days. It's not super long at all. So that's it. The last thing I want to just kind of summarize this is we can learn again from Peter Thiel. Personally, I think what he did was brilliant. And I don't think there's anything wrong with accumulating large amounts of wealth in a Roth IRA. That's why I went to law school, and that's why I became a tax lawyer. And that's what the Supreme Court case Gregory v. Halloran allows us to do, which is to minimize our tax in a legal way. And that's what he did by investing in a Roth IRA. You want to be mad at anyone, don't be mad at rich people like Peter Thiel. Be mad at President Clinton, who was a president at the time the Roth IRA was created. Be mad at Congress, be mad at the Senate. Maybe they'll cap Roth IRAs. Not sure if that's a good thing for our country when you start capping people's wealth. Don't think that's too American, but maybe I have a different opinion that's maybe not mainstream anymore. I don't know, but that's my take, and I'm just going to tell you what my thoughts are. Other than that, there's a blueprint for how you can do this if you have the right facts and circumstances. You have the ability to put in a small amount of money and take a risk on a startup. Consider it in a Roth IRA, especially if you're going to own less than 50% of a personal interest in that company, or you're going to be passively involved. It may turn out to be a tax-free home run, which you'll celebrate once you reach the age of 59 and a half. So thanks again for everyone that jumped on this. I hope you guys enjoyed it. I had a lot of fun. Keep the questions coming. I'm going to try to do this, every week or so, kind of hit you up. I may subscribe to the channel, because if you subscribe, you'll get notifications when I go live. And I may just kind of on a Sunday, just be like, I'm going live. If something pops up, right? If President Biden talks about increasing capital gains tax rate and there's something on it. If Senator Widener talks about the Roth IRA caps. If there's another expose on another rich guy with a big Roth IRA, I may jump on. If there's retirement legislation, if there's crypto news, if there's just, hey, I'm bored, I'm here, I want to answer all your questions, just hit me up, I'm going to do it. So subscribe, because that's the best way of getting notifications when I'm going live, and then you can just communicate with me. You don't have to be a client of IRA Financial. If you're a client of IRA Financial, then you're obviously smart enough. We're the best place to get a self-directed retirement account. We care about customer service. We talk to you. We invest in our people. We want to help you. Okay. And again, I'm not objective, but I do believe in what we do. And I'm super passionate about helping people explore the powers of the self-directed retirement world. We don't make money on investments. We make a little bit of money on our admin. That's it. And that's why we need a lot of accounts. So I'm not looking to push investments. I don't promote investments. I want all of you to be super successful and wealthy. And there's nothing that makes me happier. And I get these emails quite a bit, actually, where people say, hey, Adam, like I invested in this deal or that deal, and it was the best thing I ever did. I turned this amount into that. And honestly, nothing makes me happier. I feel like it's a great community of people. Even on an industry side, like we all compete, obviously we're in business, but it's a very, I think, communal, warm industry. We share information, we help each other, because we know there's lots of great, smart investors like you out there that need us as an industry to help you, because we're regulated, and help you get control of your retirement fund so you can invest in assets you know and trust. A couple last questions. Last one. Okay, can you invest in altcoins? Yeah, you can invest in altcoins on Gemini. Gemini has like 35 coins. We can also give you the ability to pull your coins off to a cold wallet. We'll give you the private keys, and then you can use a decentralized exchange like SushiSwap or Uniswap to do more decentralized trading if you wish. And we're the only, so last thing I'll say, we're the only platform that lets you pull your keys off, your cryptos off the platform. Okay, we don't charge commissions. Gemini, you're going to pay whatever Gemini charges. We have a flat fee, no termination fees, no transaction fees, no asset valuation fees. How crazy is it that some companies charge you a commission as your account grows? Isn't that crazy? Why would they do that? Makes no sense. Why should they be rewarded for your hard work and your ability to pick the right coin or the right real estate or the right founder stock? Makes no sense. So we're all about transparency, flat fees, giving you the best support. Call us, email us, hit us up on YouTube, Facebook, Instagram, Twitter. All about communicating, educating, good vibes, good karma, and nothing will make me happier than all you guys being super successful. And love to read about you guys at some point on the next ProPublica. And I'd be super proud to be like, hey, that's our client. Like he turned $2,000 into 25 million or 50 million. And it happens. I've seen it. I have many clients over $100 million in Roth IRAs. I have many clients with over 5 million in Roth IRAs. And they're smart people, but they put work into it. They do their diligence. They spend time thinking about these investments, and they're wise enough to know that they're going to do this in a Roth IRA to lock in their growth. So basically, thank you all for, again, listening, watching. Really enjoyed it. Have a great 4th of July. I hope you're getting out there. I'm in New York for the first time in like a year and a half. It feels great. I'd say New York City is like 30% back. Still super quiet, but the energy is coming back, and we're getting through COVID, and it feels so damn good. And I can't wait for things to get back to normal. So hope you enjoy your 4th. Hope be with your family, have fun, enjoy life. It's great. It's great to be back. So again, thanks again, and subscribe, because I'm going to go live again at any notice. Who knows? Maybe tomorrow, maybe a week. I don't know. Depends on what goes on. So subscribe, and you can check me out anytime I go live. Thanks again, and happy 4th.